Looking to build lasting wealth without the stress of constant trading? ETFs, or exchange-traded funds, are one of the smartest ways to grow your money over the long term. In this video, we'll dive into the best ETFs for long-term wealth, the set and forget kind that let your investments work quietly in the background while you focus on life. Whether you're just starting out or looking to optimize your portfolio, these ETFs offer diversification, stability, and growth potential. Let's get started. Today we will talk about best ETFs for long-term wealth, set and forget. So before we start, make sure to hit the like button and subscribe to my channel. 1. Best ETFs for long-term wealth, set and forget. In the world of investing, building wealth steadily and sustainably over time is a goal shared by many. However, the challenge often lies in choosing the right investment vehicles that require minimal maintenance, but offer strong growth potential. Exchange-traded funds, commonly known as ETFs, have emerged as one of the best tools for long-term wealth creation, especially for investors who prefer a set-and-forget strategy. These funds provide broad market exposure, low fees, and diversification, making them ideal for anyone looking to grow their money over decades without the stress of frequent trading. This article explores why ETFs are perfect for long-term wealth, highlights the best ETFs for this purpose, and explains how to build a resilient portfolio that you can confidently hold for years. 2. Why ETFs are perfect for long-term, set-and-forget investing. ETFs combine the best features of mutual funds and individual stocks, providing instant diversification by holding a basket of securities while trading on exchanges like a stock. This diversification is crucial for mitigating risk over long periods because it prevents your portfolio from being overly reliant on any single company or sector. ETFs also tend to have much lower expense ratios than actively managed mutual funds, often below 0.1%, which means more of your returns stay in your pocket. Unlike mutual funds, ETFs offer intraday liquidity, allowing you to buy and sell shares throughout the trading day at market prices. For long-term investors, this means easy access without the need for complex management. The simplicity, combined with broad market exposure and low costs, makes ETFs an ideal choice for set-and-forget portfolios designed to grow wealth steadily over time. 3. The principles behind a set-and-forget ETF strategy. A set-and-forget strategy means selecting strong, reliable ETFs and holding them for the long haul without frequent rebalancing or trading. This approach leverages two key investment principles: compounding and market growth. Historically, broad market indices have generated average annual returns between 7% and 10% over decades, despite periods of volatility and downturns. By holding a diversified portfolio of ETFs through market cycles, investors can benefit from the overall upward trajectory of the market. Regularly reinvesting dividends further accelerates compounding, growing the investment exponentially. Moreover, avoiding the temptation to time the market or make impulsive trades reduces emotional decision-making and fees, both of which can significantly erode long-term gains. 4. Essential ETF categories for long-term wealth creation. To create a truly robust set-and-forget portfolio, it's important to understand the key categories of ETFs that provide balanced exposure and growth potential. Total stock market ETFs. These funds provide broad exposure to the entire U.S. equity market, including large, mid, and small-cap stocks, offering comprehensive diversification in a single fund. S&P 500 ETFs. Tracking the top 500 U.S. companies by market capitalization. These ETFs focus on well-established, blue-chip stocks known for stability and consistent growth. International ETFs. To reduce concentration risk and capture growth from global economies. International ETFs invest in companies outside the U.S., including developed and emerging markets. Dividend growth ETFs. These funds target companies with a strong track record of increasing dividend payments, blending income with capital appreciation. Bond ETFs. Bonds add stability and income to a portfolio, balancing out the volatility of stocks, which is essential for preserving capital over the long term. Choosing ETFs from these categories and balancing them according to your risk tolerance and investment timeline is key to a successful long-term portfolio. 5. Building and maintaining your long-term ETF portfolio. To build a successful long-term ETF portfolio, start by defining your risk tolerance and investment horizon. Younger investors can afford to allocate a higher percentage to stock ETFs like DTI and VXUS, whereas investors closer to retirement should gradually increase bond allocations with funds like AGG to reduce volatility. Set your allocation based on these factors, then purchase your selected ETFs and commit to holding them through market cycles. While this set-and-forget approach minimizes frequent trading, it's wise to review your portfolio annually to rebalance and maintain your target allocation. Automation tools available at most brokerage platforms can assist with rebalancing and dividend reinvestment, ensuring your portfolio stays aligned with your long-term goals. In the ever-evolving landscape of investing, the appeal of low-maintenance, long-term strategies remains strong, and for good reason. Exchange-traded funds, ETFs, provide a powerful way to build wealth steadily over time with minimal intervention. For investors who prefer a set-and-forget approach, choosing the right ETFs can lay the foundation for future financial stability and growth, all while reducing the need for constant monitoring or active management. The best ETFs for long-term wealth typically share a few key characteristics: broad diversification, low fees, solid historical performance, and alignment with long-term economic trends. Funds like Vanguard Total Stock Market ETF, VTI, and Schwab U.S. Broad Market ETF, SCHB, offer exposure to the entire U.S. equity market, making them excellent core holdings for a passive portfolio. They reflect the long-term growth potential of the American economy, and with ultra-low expense ratios, they preserve more of your returns. Global diversification is another important aspect of long-term investing. Funds like Vanguard Total International Stock ETF, VXUS, and iShares Core MSCI Total International Stock ETF, IXUS, provide access to international markets, helping spread risk beyond domestic boundaries and capturing global economic growth. Including a portion of international ETFs in your portfolio can also help mitigate regional downturns and currency fluctuations. For those seeking balance and stability, Vanguard Total Bond Market ETF, BND, or iShares Core U.S. Aggregate Bond ETF, AGG, offer exposure to high-quality U.S. bonds, acting as a cushion during equity market volatility. In the same vein, dividend-focused ETFs like Vanguard Dividend Appreciation ETF, VIG, provide a stream of income and may help withstand market downturns through consistent, high-quality payouts. The beauty of these ETFs lies in their simplicity. Once your portfolio is constructed with a diversified mix of stock and bond ETFs, it requires little more than periodic rebalancing and steady contributions. This approach minimizes emotional decision-making, market timing errors, and short-term distractions, key pitfalls for many investors. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.